Hi, I'm Kara Murphy, and this is Money with Murphy. Hard to believe, but we're already in the second quarter of 2024. With the first quarter in the rear view, let's talk about what happened and what we're expecting next. The S&P 500 had an impressive start, ending the quarter up over 10%, its strongest start since 2019. The market was led by communication services, energy, and technology. In fact, every sector in the S&P 500 finished positive with the exception of real estate. Stocks that make up the Magnificent Seven, after extraordinarily strong performance last year, were much more uneven in the last few months. Nvidia, Meta, Microsoft, Amazon collectively were up 38% year to date, while Tesla, Google, Apple were collectively down 11%, highlighting how often winners don't persist. While the Magnificent Seven may have uneven performance, a variety of other names took the lead, allowing the market to broaden out. Meanwhile, returns among bonds were less impressive. Performance overall was slightly negative to flat, with the exception of high-yield bonds, which finished up almost 2%. Long-term interest rates increased in the quarter, undoing about half the decline they enjoyed late last year, driven largely by inflation concerns. Recent economic data has confirmed those concerns, coming in hotter than the Federal Reserve would like. Consumer prices are rising 3% year over year versus the Federal Reserve's target of 2%. This disconnect has prompted Federal Reserve officials to strike a more cautious tone around rate cuts, pushing expectations of a Fed rate cut to ever later in the year. With inflation running hotter than comfortable, economic growth also remains strong. Businesses continue to create more jobs than expected, buoying American workers. And after 14 months of contraction, manufacturing has finally entered expansionary territory. This strength makes it harder for the Fed to justify rate cuts. That said, the Fed will likely take a back seat in investors' minds as election season heats up. Often in election years, we see heightened volatility in the market, particularly in the late summer and early fall. Interestingly, election years typically finish just as strong as non-election years, and previous cycles show little correlation between what party is in power and how the market does. As usual, a diversified portfolio and a disciplined investment strategy is the best way to protect yourself from short-term volatility and adverse market events. Until next time, invest wisely and live richly.